This has been a historic month of November.
Volatility this year has been absolutely off the charts. There is no hope to containing the virus. Much better than expected news about the efficacy of the first two vaccines.
Mike, welcome to December. This has been a historic month of November in the global markets and probably the best market, U.S. equity market in 30 years. So let's do a recap of what happened in November, and then we can talk about post holidays and what we look for in December.
If you measure the performance of global equities, global stocks, so the broadest index is the MSCI All Country World Index, was up over 12% just for the month of November. That is the best 1 month return since the inception of that index in the 1980s. So it was a very broad-based rally, probably the most breadth we've had in any given month since April, when basically everything went up post-COVID. So a very strong rally across the board. The S&P 500 adding about 11% to its gains, its year-to-date gains, now up over 14%. Small caps in the US were the big winner. So the Russell 2000 index up 18%. That's the strongest 1 month return for US small caps also since the 80s. And then foreign equities did well also. So emerging markets up over 9%. Some of the more beaten down foreign developed markets, some of the European economies did very well. The markets in Italy, Spain, Germany, and so on. So foreign developed markets up over 15%, and the dollar weakened. So as a diversified equity investor, it was, literally the best month ever, but sort of everything was going right in order to get some very, very strong returns for the month.
Yeah, it's crazy how 1 month like this, and given the fact that we had essentially a correction in September, that we've had this type of month, and put into perspective, I think the next chart shows just the crazy outcomes here over the last 30 years.
Yeah, looking at the monthly returns for the MSCI ACWI index, and you can see there the month of November, the high over 12%. We had some really bad months. So the fourth worst month ever was March of this year. So the volatility this year has been absolutely off the charts. But overall, for those that stayed invested, and there have been so many opportunities to get out of the market and miss out on these gains. You think about the setup heading into November. We're just coming off of a technical correction in September. You have the election looking very uncertain, a rise in COVID cases, looking for a big second or third wave, depending on how you're looking at it, globally heading into the fall as we all move into the indoor season. And on the back of that, the market goes up over 12% broadly. So, these dynamics at play in November, where the market willing to look through the virus outcomes and focusing on the flow of money, and then also the vaccine news. Those are the things driving markets, not necessarily COVID case counts right now.
Mm-hmm. Yeah, I think that's good perspective. Take a look just specifically at the S&P and tell us about the all-time highs we set here.
Yeah, the S&P set its most recent all-time high at the very end of August. And then went through that 10% correction in September. October had a decent start, had a little bit of a sell-off pre-election, and then you can see the rally there in November, which is sort of that last move up to new all-time highs. That last rally in November is important because it's been much broader than the market rally so far, much more inclusive. Things like value stocks outperforming. Things like small cap stocks outperforming. During the month of November in particular, you just take a collection of all the industries and companies who you would say their business models have been most significantly impacted by the pandemic, and they had the strongest returns during November. Energy, industrials, materials, retail and hotel and office REITs, which with some very strong returns. Any type of energy exploration company. All those areas of the market outperforming and doing extremely well during this last bump up to new all-time highs.
Let's shift gears and talk about the COVID situation and look at case counts and the news that we've been watching there.
Yeah, the case counts we move and look at the case counts, no good news to report. We talked about how the 7-day moving average of COVID cases reported in the US was moving up exponentially. If you're looking for a silver lining, you could say that late in November, they sort of stalled out and topped off. We don't believe that's necessarily the top in cases. What's more likely to happen, what the sort of consensus is around this, is that there was a lot of mobility during the Thanksgiving holiday, and a lot of people weren't getting tested, but they were in very close proximity with a lot of other people during that time. And so that sets you up for, anywhere from 1 week to 3 weeks out from Thanksgiving for another surge in cases broadly. And that brings you right into Christmas, which should be more of the same behavior, a lot of people gathering again, which sets you up for another surge in cases 1 to 3 weeks after Christmas. So like we said previously, the COVID situation in the US in terms of cases is not likely to get better before the end of the year, as we're in the indoor season and people have excuses to come together during the holidays. And this is happening during a surge in testing. So you have a exponential increase in cases during this wave running into an exponential increase in testing activity, and you're going to get more cases.
The good news, bad news, right? As we look forward, the market generally has sort of discounted all this information. The more cases are priced in. So what do we expect in terms of the market's interpretation of the vaccine, and maybe if there's any update on vaccine stats you can provide?
Yeah, there's no doubt that the market has been far more focused on the vaccine. At this point, there is no hope to containing the virus. The only way to get back to normal is through an effective vaccine. And in early November, we got much better than expected news about the efficacy of the first two vaccines, the Pfizer vaccine and the Moderna, both of which use messenger RNA technology to create their vaccine. So those are both over 90% effective in initial trials, and both have thus far applied for emergency use authorization. So that is the news that has got the market excited. The market is looking at these vaccines and looking at the distribution challenges, and not just the Moderna and the Pfizer, but also the AstraZeneca and potentially 6 other vaccines that could get approved for emergency use sometime during, hopefully, early first quarter, if all goes well with their testing. And basically what the market is starting to, the picture the market is starting to paint is, as we get into Q2 2021, the hope is that you should be able to walk into your Walgreens or CVS and get a vaccine. And that vaccines will be distributed broadly to the general population. And that very quickly, starting in Q2, the US could start approaching herd immunity. And so that is what the market is looking forward to. They're looking past this surge in cases and saying, I almost don't care how bad it gets. I care more that it's the last one and that there's a light at the end of the tunnel. And that's what the market is discounting. And all the vaccine news, aside from the AstraZeneca news that they have to go back and redo some of their trials, I mean, all the other news on vaccines and therapeutics has been excellent and supported that view that as we move into the back half of next year, it's possible we could have limited to no COVID restrictions on mobility in this country, and maybe even not need mask mandates, and businesses could reopen. So
That sounds like a very good outlook. I think a lot of people would be happy with that, because everyone wants to sort of get out. Let's talk about, real briefly, the status of stimulus on the fiscal side and where things are at there. And given the vaccine and the potential for the economy reopening sometime next year, what's the likelihood of stimulus? We know the market likes stimulus, but give us some perspective there.
Yeah, the first pit stop where you could get some new fiscal stimulus spending is in mid-December, Congress has to pass a funding bill, the budget, and they could weave in some fiscal stimulus at that point. If they were to do that, which seems unlikely, it probably wouldn't be anything spectacular. So you're talking maybe 500 billion, maybe we add a little bit more to PPP, which who's to say those funds would even get used. But that would be your first opportunity at fiscal stimulus. And then as we move out, once the new administration gets set in and we get past these runoff elections in Georgia, that's when we'll see Congress has taken shape, and that's when there likely is going to be stimulus at some point during the first quarter or the second quarter. There's likely to be stimulus. The size and the makeup of that stimulus is somewhat dependent on what happens with these two runoff elections, Senate elections in Georgia. If both of those were to go Democratic, that would be a very positive outlook for stimulus. There you're talking about potentially a $2 trillion to $2.5 trillion stimulus package. But even if both of those Senate seats or one of them goes Republican and we have a split Congress, you're still likely to see something between 500 billion and 1 trillion is sort of the baseline expectations for stimulus. And at this point, we've talked about this previously. If you look at the household balance sheet data, the consumption data, the retail spending, the personal income data, you can make a very plausible argument, a very valid argument, that the average consumer does not need more stimulus, does not need more fiscal support. And so the market is in many ways looking at the potential for more stimulus and more deficit spending either in December or in the first quarter of 2021 as just sort of the cherry on top. And just another reason to be exuberant, almost like it's too much too late in terms of stimulus. It's not really necessary, and it's far later than it should have been. So the market is very bullish on that, and that's why you're seeing a lot of these cyclical areas in the market starting to outperform, because the market starts to look forward to that as well.
Yeah, I think Jerome Powell has said you'd rather err on the side of too much stimulus, both monetary and fiscal, than too little, to sort of give ourselves enough escape velocity to get out of this pandemic. But we've got a lot of information that we're looking at in terms of what we see as we go into next year, the bull case, the bear case, and our base case. Mm-hmm. We're going to be sharing that in separate video, but maybe as we wrap up this video today, can we share a few sort of elements of that, maybe discussion-wise? Maybe just start with personal income. We can throw that chart up and talk about what that looks like.
Yeah. If you look at personal income, and the personal income data has been heavily influenced by the economic impact payments and the expanded unemployment benefits. So you strip those elements out, and you just look at the personal income data, sort of the clean personal income data. And what you see is the U.S. economy has already gotten back to trend, which has been, shocking, far better than expectations. And you compare that to 2008, for example, it took 3 to 4 years before personal income got back to just sort of average trend levels to recover from the global financial crisis. So, that is a bit of the bull case. Is if we get into next year and you have household balance sheets and personal income in a good shape, and the labor market continues to recover, and you get a vaccine, then you could have a very strong recovery and a continued increase in retail spending and consumer spending that beats expectations. So it's a pretty attractive setup. As long as the virus is taken care of and there isn't a ceiling on the recovery, we think there's potential that this could very much be a coiled spring, and the recovery could definitely beat expectations next year.
Yeah, absolutely. And I think the other chart maybe we just comment on before we go here is on the consumer balance sheet health, and just how that fits in with what you just said.
Yeah, exactly. So you look at household savings, and household savings are at the highest levels in 30 years. And then you look at the debt service ratio, and that's the lowest level in 30 years. So once again, the economic growth has been subpar, certainly in 2020, not because there is no money. It's just there's nowhere to spend it. So consumer balance sheets are healthy. Savings are just future consumption. And so if you get a situation where the economy opens back up and there are places to spend this money, we think consumers will do that.
So as we go forward, we're going to be looking at our capital market assumptions as we head into 2021 and beyond. And given what's going on in the bond market and how portfolios need to earn certain returns in order to be successful, we'll be sharing sort of the longer term capital market expectations that we have been developing, and also sort of the near-term outlook for some of these asset classes. In particular, we'll be sharing our bear case, our bull case, and our base case for 2021 as we go forward. So look forward to that, Mike. And in the meantime, let's finish December strong.